All right, welcome to a supplemental section of financial accounting. Some of you have been asking me about in homework 3.3, the SC 3-1 through 3-5 questions, the problems there. They're multiple choice questions. They're somewhat confusing, and I think the reason why is because the dates offered to you from the Cheesecake Factory are a little weird. So let me try to explain what's going on in Cheesecake Factory. The Cheesecake Factory has an operating year of 2016. But the starting date for its operating year 2016 falls on the somewhat awkward. It's going to be on the Wednesday, and it's going to be each operating year ends on the Tuesday that's closest to December 31st. So for Cheesecake Factory, the last day of operations in 2015 was actually on 12/29/2015, which means the beginning of their 2016 year begins on 12/30/2015. It seems weird, but it's close to the end of the prior year. So we're going to start, that's the start of 2016, and it runs all the way to the last day being January 3rd, 2017. So it's got slightly more than 365 days in its operating year, but that's its 2016 fiscal year. Okay. So if we're going to take a look at some of these problems here, let's just be clear that the balances in some accounts are stated as of 12/29/2015. That's the beginning balances for the fiscal year 2016, running all the way through 2017. So given that's the case, let's kind of go through and try to sort out what's going on here. The question asks a lot about how adjusting journal entries affect the financial statements, or what journal entries are needed to adjust certain accounts. Prepaid expenses primarily are supplies. I don't like that they use the word prepaid expenses in this problem, but prepaid expenses is the correct terminology for current assets that are going to be consumed over a short period of time. So just think about prepaid expenses as a supplies account. Okay. So it says that the beginning balance, which is last year's ending balance of supplies, so at December 31st, at prior year end, there was 13,378 debit balance in the supplies account. That's last year's ending balance, this year's beginning balance. A physical count of the prepaid expense performed at the end of the current year revealed 12,580 of supplies on hand. So that's the balance we need to get to, but it's currently not recorded in our accounting system. How do we get there? Well, they tell us other information. They say that during 2016, purchases totaled 63,500. So the question comes down to, how do I go from 13,378 plus 63,500 down to 12,580? I need to actually record a journal entry that recognizes that 64,298 of supplies were consumed. So in other words, we start with 13,378, we add 63,500, 64,298 must have been consumed because the ending balance is 12,580. That's the journal entry we need to record to get to this balance. What is the offsetting debit that we need? It's going to be to supplies expense on the income statement. So we will record a debit 64,298 in supplies expense. That's the journal entry that is needed to adjust the supplies account. And if it's only adjusted once per year, just go ahead and assume that there is no amount that has been recorded at all in 2016. So 64,298 is the amount of supplies expense in this case. Prepaid rent, another current asset, had a beginning balance of 5236. And maybe that represents 1 month's, let's just call it 1 month's worth of prepaid rent that was left. So what do we need to do during the period? We need to increase that account by another prepaid amount, $47,700. And we need to acknowledge that there's going to be a balance, maybe 3 months worth left at the end of the current year of 16,072. Maybe that's 3 months worth of rent that's left over. How do we get there? We need an adjusting journal entry that recognizes that 36,864 in rent was consumed during the period. That's how we get down to 16,072. Start with 5,200, add another 47,700 in prepayments, consume 36,864 in rent throughout 2016. We still have another 16,000 left to go, starting in the next fiscal year. This means we're going to have to record some sort of rent expense. And assuming that we haven't recorded any rent expense to date, we'll just go ahead and assume there's a zero beginning balance. No big deal there. 36,864 is the journal entry, the debit that goes with that credit. The gift cards are somewhat confusing, but they represent a liability. Specifically, gift cards represent unearned revenue. When people pay for a gift card, cash is given to the Cheesecake Factory and the people walk away with a gift card. Cheesecake Factory takes the cash and they have to record unearned revenue. So imagine, just to give you an idea here, that the way the gift cards work, and they are a liability. So just kind of keep this in your mind. Someone pays cash. Cash is recorded as a debit. Cheesecake Factory cannot record anything as revenue because it's essentially a prepaid meal. So they're going to record a liability on the credit side. When somebody cashes in or uses that gift card, Cheesecake Factory will debit that account and then recognize the revenue as people consume their meal. That's how the process works for any type of gift card arrangement. It's essentially just unearned revenue. So in this case, Cheesecake Factory has a beginning balance in its unearned revenue liability account, gift card account of 153,629. It sold another 379,000 to customers, and it has an ending obligation to customers. The amount of gift cards outstanding at the end of the year is 123,619. That's how much money is held in people's pockets in the form of a gift card. That account must have decreased. It's a liability, it decreases with a debit. So how much did it decrease during the year? Well, in this case, it must have decreased by 409, excuse me, 010, which means that revenue must have been earned of that same amount from gift cards. There's some cash transactions for sure during the year, so there's probably going to be some sort of credit balance in the revenue. But the key thing to realize is the gift cards brought in another $409,000 worth of revenue. Salaries and wages payable. They give us a lot of information here. But the key number here we need to focus on is the 39401. Specifically, they say that as of January 3rd, the end of the current year, Cheesecake Factory employees had earned salaries and wages of 3409, but they hadn't been paid yet. They'll be paid early in 2017. Call it, maybe it's on the 5th or the 6th or the 15th. So what we need to acknowledge is that salaries and wages payable as a liability probably has a zero beginning credit balance because typically we pay employees every couple of weeks. So there's probably no obligation already in salaries and wages payable. So what we need to record is 39401 as a credit to salaries and wages payable, which represents the current amount that's owed to employees that will be paid in approximately another week, but it will be paid in the next fiscal year, sometime in mid-January 2017. In the meantime, we will acknowledge that there is a salaries and wage expense that has not yet been paid in cash, and that debit will be 39,401. And likely there will have been some balance already in salaries and wages expense. But the key thing to realize is we need to bump up the salaries and wage expense for those salaries and wages that have not yet been paid. So the credit is not to cash, it's going to be to the salaries and wages payable. What do we do now? Here's the overall effect of these adjusting journal entries. We see that there is a additional amount of revenue of 409,010 to the income statement. So down below, I'm just going to sort of sketch out the AJE effects to the income statement. There's already revenue and expenses. There are already revenues and expenses on the income statement, but the effects themselves, we're going to see an increase to revenues of 409,010. And again, those are just the gift cards, gift card revenue. We're also going to see some expenses here. So we've got salary expense, let's do supplies expense. Supplies expense. We've got rent expense, salary and wage expense. And those amounts are above. So we see supplies expense 64,298, rent expense 36,864, and salaries and wage expense of 39,401. So let's show these as negative numbers here, just to kind of keep our math straight. 64,298, 36,864, 39,401. The overall effect to operating income is a net amount of 26,847. So the effects are an increase to operating income given these adjusting journal entry, given the adjusting journal entries that we're recording up above. If we didn't do these adjusting journal entries, we would not see revenue of 409,010. We would not see supplies expense of an additional amount. These items would not be recorded. Therefore, they would not show up on the income statement. So if Cheesecake Factory did not record any of these adjusting journal entries, it would be reducing its overall operating income and net income by 268,447. So it's important to do adjusting journal entries to capture those effects. If you have any questions, please let me know.